Sajid Chinoy from JPMorgan as well joins in on board. Sajid, hi, morning. What is your own estimate in terms of what the FY14 and 13 projection for GDP is going to look like?
Well, we're slightly more conservative. We're in the 5.8% range, quite simply because, remember, we're still in a path of fiscal consolidation. And I take the government at its word that it's serious about fiscal consolidation. That's contractionary. That will pull growth down in the near term, even though that's clearly has a very significant positive impact in the medium term. So we're in a lower range. I don't think above 6% is out of the realm of possibility. But we'll have to get lucky. We'll have to see a situation where global growth picks up and therefore exports pick up. We'll have to observe a normal, healthy monsoon. And apart from luck, there'll have to be a lot of hard work. There was some good news last night that the Cabinet Committee on Investment has cleared a bunch of oil projects, energy projects. For me, that's the most important variable. That the biggest hindrance to growth in India today is very binding supply bottlenecks on the ground that are preventing more robust corporate investment. If those bottlenecks can be alleviated, then 6% growth and above is not impossible. But without significant policy action on that front, it will be tough.
Sajid, if your estimates for FY14 are less than 6% at 5.8%, I wouldn't say they are conservative. That's outright bearish.
Well, we're going to grow at 5% this year. We grew at 6.2 the previous year. 5.8 is still a pretty significant acceleration from these levels. Remember, the fiscal deficit is going to move from 5.2 to 4.8. That's going to have a contractionary impact on economic activity. Clearly, if commodity prices remain at these levels, if inflation moderates further, that will give the RBI some space to cut interest rates even more. But we have to ask the question, are interest rates the real constraint today on investment, or are they supply bottlenecks? And I think the government itself realizes these are non-monetary supply bottlenecks: land acquisition, coal availability, environmental clearances, raw material availability. So yes, if those bottlenecks are dramatically alleviated this year, if there's bold policy action, we can get above 6%. But absent those bottlenecks, in a global economy that's clearly still a bit wobbly, remember, if commodity prices remain at these levels for the rest of the year, which will help our current account, that also perhaps suggests that global growth will not accelerate very sharply. So we may not get too much joy in the export front. So we have to be realistic here, I think.
Sajid, the PMEAC is likely to peg the FY13 current account deficit at 5% and FY14 is likely to be even lower than that. What is your own estimate?
Right. I think on that front, we're on the same page. We're at 5% for this year. That's still about $90 billion or so. Next year, if gold is lower, if we've already seen gold volumes come off actually the last few months, so that's a positive. If crude prices at $100 a barrel as opposed to 110 or so that they were this year, together those are 40% of India's imports. So if that comes off, and export growth doesn't fall off very sharply, then we'll certainly see a moderation in the current account. But remember, it's a fine balance here. If commodity prices are lower in the world because global demand has slowed, that will also affect our export growth. Remember that. So we need to be lucky, whereby exports still grow at some rate. At the same time, the commodity prices remain quite muted. If you have that combination, a number below 5% is, I think, quite realistic for next year.
Sajid, as I understand that the government spending for the quarter gone by, which is Q4, was rather anemic. Do you think government spending for FY14 could make a comeback? Exactly. And that in a sense could change your projections? And also state elections towards the second half of this year. And historically, we've seen that whenever there are bunched up state elections, yes, it will lead to some kind of an inflow back into the economy.
Yes. No, I think that's reasonable to expect. But remember, we had the same expectation last year that, in the last quarter of the year, the government will be forced to spend. We're approaching a pre-election year and the government did not. I think the government's very serious about fiscal consolidation. So 2 points I want to make. One is the fact that growth slowed so sharply to 4.5% in the fourth quarter of 2012 was in large part because government spending that quarter was so weak, and you saw that in the community social services subcategory of growth. The same is going to be true in the first quarter of 2013. So we have to recognize that lower government spending will affect growth in the short run. Next year, my sense is if you get a big pickup in tax collections, and that's a surprise, a positive surprise, then that will allow the government more space to increase consumption later in the year. But absent that, what I suspect will happen will be a similar pattern to this year, where rural development and, for lack of a better term, election-related spending, whether it's the Food Security Act or other welfare programs, will get their full budgetary allocation. And you might have some cutback again on planned expenditures, so that you can both achieve your spending targets in the rural economy without violating your budget constraint, which is still on a path of consolidation. So I think that's the composition of spending might change to achieve both these objectives.
Sajid, you were just talking about gold prices. What is your own reading of how oil and gold prices are likely to pan out going forward? Is the downtrend sustainable? Because that does, tend to help economies like ours.
Right. But clearly India is a very big beneficiary of commodity prices, of gold and oil being, and we're one of the biggest beneficiaries in the world. The question is this sustainable? I mean, to be fair, there are many moving parts to the puzzle. Nothing has changed from an economic fundamental perspective globally over the last 4 weeks to warrant such a sharp correction, particularly in gold prices. One can understand some softening of base metals, given that activity in China has been slightly weaker than we had expected. But for gold, nothing has fundamentally changed. So the sense is a lot of this is a technical correction. Some of this may be overshooting. But a lot of what's going to happen to gold is going to depend on expectations from central banks going forward. If there is a notion that QE3 is going to be withdrawn earlier and more aggressively than had been expected, then the downward pressure on gold prices could continue. If, however, there's an expectation that you're still going to have large balance sheet expansion, that the Fed will do this for all of 2013, that we know Japan is expanding at a very rapid pace, then I'm not sure the fundamentals would warrant such a sharp correction, and this could just be a technical correction that eventually mean reverts at some point given the fundamentals.